The silver paradox. Supply is vanishing, but price keeps falling. Somewhere, in a vault no one is watching, silver is disappearing, ounce by ounce, year after year. 6 years in a row, the world has used more silver than it has dug out of the ground, and yet, the price on the screen keeps going down, down while the shortage grows, down while the vaults empty, down while the world quietly runs out. How is that even possible? Somebody is wrong. Either the price is lying, or the shortage is a warning nobody wants to hear. By the end of this video, you will know which one it is, and you will understand why the answer changes everything. Welcome back to John A.G. Now, before we go any further, I want to ask something of the ones among you who have lived long enough to know when something doesn't add up. If you're the kind of person who worked for what you have, who doesn't trust a headline just because it sounds confident, hit that subscribe button. Not for me, for yourself, because what you're about to hear is the kind of thing you'll want to have followed from the beginning. And tell us, where are you watching this from tonight? What city, what country? Type it below. I read every single one, and I like knowing who's really listening. Now, let's begin. In the world of commodities, there is a rule so old that most people forget it is a rule at all. When something becomes scarce, its price rises. That is not opinion. It is the most basic law of markets, taught in the first week of every economics course on Earth. Scarcity pushes price up. Abundance pushes price down. For centuries, this law has held. But in the silver market of 2026, something strange is happening. Something that does not fit the rule. Something that, once understood, forces a person to ask a much bigger question about what is really going on beneath the surface of the financial world. For 6 consecutive years, the global silver market has produced less silver than the world has consumed. Not once, not twice, 6 years in a row. Mines dig, refineries process, industries buy, and still, every single year, the world takes out more silver than it puts in. This year, the gap is expected to widen even further, growing by around 15% compared to the year before. And yet, silver's price has not risen to reflect this. It has fallen, sharply. Investors who watch the headlines see a metal in retreat, sliding lower week after week, apparently unwanted, apparently unloved. On paper, everything about silver looks weak. But paper is not the same as reality. Somewhere far from the trading screens, in vaults across London and New York and Shanghai, something else is happening. Physical silver, actual bars, actual coins, actual industrial stock is being withdrawn. Quietly, steadily. Year after year, hundreds of millions of ounces have left storage to cover the difference between what the world produces and what the world needs. This is not a theory. It is documented, tracked, and reported by the very institutions that monitor the metal. So here is the paradox, stated plainly. The shelves are emptying, the shortage is real, and it is getting worse. But the price, the number that is supposed to reflect scarcity, is moving in the opposite direction. For a business-minded person, this is not just a curiosity, it is a signal. Somewhere in this story, either the shortage is being misunderstood or the price is being manipulated by forces that have nothing to do with silver itself. To understand which one it is, a person has to look past the number on the screen and understand where that number actually comes from. Because the price everyone sees each day is set on a trading floor, by short-term bets, by algorithms, by decisions made in seconds based on interest rates and currency movements. It has almost nothing to do with how much physical silver actually exists. Meanwhile, the physical world moves on a completely different clock. Mines cannot simply produce more silver on demand because most of the world's silver does not come from silver mines at all. It comes as a side product of digging for copper, lead, and zinc. The companies pulling ore from the ground are not thinking about silver prices when they decide how much to dig. They are thinking about copper prices, lead prices, zinc prices. Silver simply comes along, whether the market wants more of it or not. This means that when demand for silver rises, the supply side cannot respond the way normal economic theory expects. There is no lever to pull, no factory to open faster. The metal simply is not there to be produced in greater quantity, no matter how badly it may be needed. This is where the paradox begins to make sense, and where the real story starts to unfold. To understand why silver behaves the way it does, a person first has to unlearn something. Most people imagine a silver mine as a place built specifically to dig up silver. A company finds a silver deposit, builds a mine, and pulls silver out of the ground. That picture feels logical. It is also, for the most part, wrong. The truth is stranger than that. Roughly 70% of the world's silver does not come from silver mines at all. It comes as a side effect, a byproduct, of mining for copper, lead, and zinc. Deep underground, in mines built to chase entirely different metals, silver rides along in the ore almost by accident. The mining companies are not thinking about silver when they decide how much to dig. They are watching the price of copper. They are watching the price of zinc. Silver is simply along for the ride, whether the world needs more of it or not. This single fact changes everything about how the silver market behaves. In a normal market, when a product becomes scarce and its price should logically rise, producers respond. They open new factories. They drill new wells. They increase output to chase the profit. Supply grows to meet demand. That is the basic engine of capitalism, and it usually works. But silver breaks that engine. Because the decision to dig it up is not being made by silver at all, it is being made by other metals entirely. If the world suddenly needed twice as much silver tomorrow, there would be no fast way to produce it. No mining company can simply decide to dig more silver, because the silver was never the point of the mine in the first place. So what happens when the world needs more silver than it can produce? For 6 years now, the answer has been the same. The difference has been quietly pulled from storage. Vaults in London, in New York, in Shanghai, places that hold physical silver bars and coins as reserves, have been drawn down year after year to fill the gap between what is dug up and what is consumed. This is where the story takes its first real turn. Since 2021, more than 760 million ounces of silver have been withdrawn from these above-ground stockpiles. To put that number in perspective, that is more silver than the entire world produces in a single year, pulled from reserves, not from new mining, just to keep up with demand. The vaults that were supposed to be a safety net have been quietly emptying for half a decade. And here is the twist most people miss. This drawdown is not slowing down. It is accelerating. This year's shortage is projected to be roughly 15% wider than last year's. The gap between what the world digs up and what the world consumes is not shrinking, it is growing, even as the reserves meant to cover that gap keep shrinking alongside it. Somewhere, a supply of physical silver that took decades to build is being drained in a matter of years. And unlike a mine, a vault cannot be refilled by simply deciding to work harder. Once the metal is gone, it is gone. The only way to replace it is through new production, the very production this market has already shown it cannot easily increase. This creates a strange kind of countdown. Nobody knows the exact date, but the math is not complicated. A pool that is shrinking every year, feeding a demand that keeps growing every year, eventually reaches a point where there is simply not enough left to draw from. And yet, despite all of this, the price on the screen keeps falling, which raises the real question. If the physical world is behaving exactly the way a genuine shortage should behave, then why does the price refuse to admit it? The answer has nothing to do with silver itself. It has to do with a completely different market, one that trades faster, moves louder, and, for now, has far more control over the number everyone sees each day. If the physical world tells one story, the price on the screen tells a completely different one. And to understand why, a person has to step away from vaults and mines entirely and look instead at a place where silver rarely exists at all, the trading floor. The number that flashes on every phone and every chart, the price that moves up and down by the second, is not set by how much silver sits in storage. It is not set by how empty the vaults have become. It is set by traders, hedge funds, and algorithms, placing bets on paper contracts, promises to buy or sell silver at a future date. Most of these contracts will never touch a single physical bar. They exist purely as speculation, layered on top of the real market like a second, louder world sitting above the quiet one. And this paper world runs on an entirely different set of rules. It does not care about 6 years of deficits. It does not care about emptying vaults. It cares about interest rates. It cares about currency strength. It cares about what a central bank chairman says in a press conference next week. Here is the twist most casual observers never see. In recent months, a new central bank leader took his seat, a figure known for a cautious, hawkish approach to monetary policy. His arrival alone shifted expectations. Traders began pricing in the possibility of higher interest rates for longer, rather than the rate cuts many had expected. And higher interest rates do something very specific to metals like silver. They raise the cost of holding an asset that pays no interest at all. Think about it from the perspective of someone with capital to place. If holding cash or bonds pays a rising return, while holding silver pays nothing and simply sits there, the incentive tilts away from silver. Money begins to flow elsewhere, not because silver became less valuable in the real world, but because the alternative became more attractive on paper. At the same time, the currency strengthened. A stronger dollar makes silver, priced globally in that same currency, more expensive for buyers using other currencies around the world. Demand from those buyers softens, at least in the short term. Combine a stronger currency with higher rate expectations, and the paper price faces pressure from two directions at once. Pressure that has nothing to do with how much silver physically exists. Then comes the third force, the one few people ever hear about. When prices fall sharply, certain trading systems are built to sell automatically. Not because a human decided silver was overvalued, not because anyone analyzed the shortage, but because a price crossed a certain line on a chart and a machine, following pure momentum, triggered a sale. These automated systems do not think. They do not know about vault withdrawals or byproduct mining. They simply follow the trend, and in doing so, they deepen it, turning a modest decline into something sharper, faster, more dramatic than the fundamentals alone would ever justify. So the price falls, not because silver is truly abundant, not because the world suddenly needs less of it, but because a separate market, moving on its own logic, at its own speed, has temporarily taken control of the number everyone is watching. This is the paradox in its clearest form. Two markets occupying the same metal, telling two opposite stories. One market, slow and physical, insists the world is running out. The other, fast and speculative, insists the world has plenty. For now, the loud market is winning. The paper price is falling, and headlines follow the paper price because it is the only number most people ever see. But there is a pattern in history that few are paying attention to right now. A pattern that shows what tends to happen when a market this loud and a shortage this real are forced eventually to meet. History does not repeat itself perfectly, but it rhymes in ways that are hard to ignore. And in the story of silver, there is a pattern that stretches back decades, one that shows exactly what happens when a loud, fast-moving paper market drifts too far from a slow, quiet physical reality. Time and again, across different decades and different economic conditions, the same sequence has played out. A shortage builds quietly in the background, ignored by traders chasing short-term signals. The paper price, driven by interest rates and currency swings, moves in the opposite direction of the physical truth. For a while, the gap widens, and the loud market appears to be winning. Then, without warning, something breaks the illusion, and the physical reality reasserts itself, often violently, often faster than anyone expected. This is the twist that most casual observers never see coming. The very forces currently pressing the price down are not permanent. They are tied to a specific moment in time, a central bank meeting, a currency cycle, a wave of automated selling. These forces can shift, and when they do, they shift quickly. A single change in tone from a central bank chairman, a single signal that interest rates have peaked, can remove the pressure holding the paper price down almost overnight. And when that pressure lifts, there is nothing left standing between the price and the shortage underneath it. No new mines can suddenly appear to fill the gap. No vault can be refilled instantly after years of withdrawals. The 760 million ounces already pulled from storage cannot be replaced with the flip of a switch. The byproduct nature of silver mining does not change because sentiment changes. The structural shortage remains exactly where it was, except now with far less cushion left to absorb it. This is the quiet danger inside the paradox. While attention stays fixed on the falling number on the screen, the underlying shortage does not pause to wait for traders to notice. It continues, year after year, deficit after deficit, stockpile after stockpile. The gap between what the world produces and what the world consumes keeps widening, even during the months when the price says otherwise. For a business-minded person, this is the real lesson buried inside the silver story. Price and value are not always the same thing. A falling number does not always mean falling worth. Sometimes it means the opposite, a genuine imbalance hiding beneath a temporary distortion, waiting for the right conditions to reveal itself. This is not unique to silver. Every serious market has moments where sentiment and structure disagree, where headlines say one thing and the underlying numbers say another. The people who understand how to separate the two, who can look past a falling price and ask whether the falling is justified by reality or simply by short-term positioning, are the ones who tend to see turning points before they happen. Not because they predicted the future, but because they understood the mechanics well enough to know which side of the disagreement was temporary. The silver paradox, then, is not just a story about a metal. It is a case study in reading markets correctly. A shortage that is real does not disappear because a price chart says otherwise. A price that is driven by short-term positioning does not reflect long-term truth. Eventually, one of the two must give way to the other, and history suggests it is rarely the physical world that bends. For now, the vaults keep emptying. The mines keep producing less than the world needs, and the price keeps moving to a rhythm set far away from the metal itself. But rhythms change. Interest rate cycles turn, currencies weaken after they strengthen, and when the paper market finally runs out of reasons to ignore the shortage beneath it, the reconciliation tends to happen quickly, and often without warning. The paradox will not last forever. It never does. The only real question left is who understands that before it ends, and who is still looking at the wrong number when it does.